Crest was founded in 2011. Our business model is to be an insurance company for capital market risk. Our return sources are volatility risk premiums. But what is a volatility risk premium? It is an asset class that you earn by spreading a short position in implied volatility versus a long position in realized volatility. Sounds complicated, but it's actually quite simple. How this is done, I will show you now. I am Matthias van Randenburg, founder and CEO of Crest. Before we start, a brief note. The following film has 3 parts. Part 1 is a case study about volatility risk premiums. In Part 2, we analyze the evolution of volatility risk premiums during the worst thinkable environment for this asset class, namely the Lehman crisis of 2008. Based on this analysis, we outline the characteristics of volatility risk premiums. In Part 3, I address the particular challenge of this asset class and explain why only in rare circumstances you should entrust your funds to a short vol manager. Here you see the long-term performance of the Euro Stoxx 50 and of its volatility risk premium. This nice and steady performance was produced by selling 1 month straddles on the Euro Stoxx 50 and then neutralizing all delta risks through an opposite futures position on a daily basis. Sounds complicated, but it's not. I will show you how it's done on a step-by-step basis for the months of June 2003. The month of June was a period during which the arbitrage pricing relationships of options materialized almost perfectly. As such, a perfect month for the following illustration. At the beginning of the month, we sell a straddle, call and put, both striked at the money and with 1 month's maturity. The market is trading at 2,330, so we will strike the options at 2,325. By selling the options, we realize premium income, the level of which will depend upon the prevailing implied volatility level. In our case, volatility is trading at 26%, and we receive 141 euros in premium. However, rather than the premium income we collect, it is important to understand the risks we assume by selling the options. This is precisely shown to the right. The delta of the call is negative, it's making us short the market. The put delta is positive, it's making us long the market. Both together net up to a 5% short position. But we do not want to carry any delta risk and must therefore hedge this 5% short position by buying futures. We buy 5 futures contracts and make a record of the transaction in the shown trade plotter. We see the date, what we did, in what quantity, and at which price. Okay, let's move on and look at our position overview, where we see the delta risks that we have in our futures portfolio and in our options portfolio. As you can see, they are both netting each other out. That means, overnight, we were actually carrying 0 delta risk. Let the next day start. The market is going up. This move makes the calls go into the money. Their delta increases, they are making us shorter. The puts, in contrast, are going out of the money. Their long delta is decreasing so that our straddle position is now making us much shorter than before. On total, we are now 28% short. This means we need to buy futures again, a total of 23 contracts, so that the overnight delta of our portfolio is again hedged to 0. We again make a record of the trade in our trade plotter, and on the right side you see our net futures position, which is 0, as the straddle delta and the futures net each other. We let the next day flow in. This time the market is falling, so the opposite will happen. The calls that had gone into the money are now less in the money, their delta has decreased. The puts are a little bit closer to their strikes, so their delta increased. On total, the straddles now make us only 21% short the market. We therefore need to sell some of the futures contracts we had bought before. On total, we have to sell 7 contracts, such that, once again, we have a perfectly hedged portfolio. A new day begins. This time the market is going up. That means I am going to buy futures again, on total 14 contracts. Next day, the market is moving down. That means I need to sell some of our futures contracts. On total, I'm selling 13 contracts. We can now let this process run for a few days, so that until month end, the following trade plotter is built up. Okay, what is this telling me? Well, we can see that every time the market went up, we had to buy futures, and every time the market went down, we had to sell futures. This trade plotter is showing us 2 things. First, it lists the history of all transactions that we need to compute our P&L. We'll come back to that. And second and decisively, no risk. For no single day of the month did we carry any overnight market risks. The net delta position of our portfolio was always hedged to zero. But why go through all this hassle? This can only be answered by computing the profit and loss that this process produced. To do that, I have to compute the P&L we made by selling the straddle and the P&L we made in our hedge portfolio. And this is precisely what we will do over here. The first part of this analysis is trivial. We have to look at the value change we incurred in the straddle position. We sold the straddle for 141 and at expiry it was worth 95. Why 95? Well, the call actually went into the money and expired with an intrinsic value of 95. The put expired worthless. As we sold 100 straddles, we are earning 100 times the difference of 141 to 95, which is 46 per straddle or 4,600 euro on total. We can now relate this result to the nominal capital at work, and I assume this was 100 times one straddle strike, which means 100 times 2,325, which yields a profit of 1.97%. Perfect. We have done the first half. Now we have to compute the P&L of our futures portfolio. For that, we have to multiply the futures position that we carried from one day to another with the price change realized during that one-day period. We do this on a day-by-day basis, and we also show the cumulative performance of this process. And we see that during the month of June, the hedge portfolio produced a loss of 3,467 euros, which corresponds to 1.48%. All that is left to do now is to add up both results. 1.97 gain on the straddle minus 1.48 loss on the hedge makes a net result of 0.49% or 1,133 euros. Well, so far so good. However, in my experience, this sort of computation is the wrong approach to actually grasp the economics of the volatility risk premium. It's much more helpful to analyze how implied and realized volatility relate to each other. Remember, we sold volatility at 26%, but what was the volatility that we realized in our hedge portfolio? What we actually did was to replicate the return path of these two options, but not with some theoretical implied volatility, but rather by using the true realized market volatility, the volatility that materialized through the futures transactions of our hedge portfolio. We therefore recall our trade plotter and compute the volatility of the futures transactions recorded in this plotter. The formula that you see might look a bit complex, but it's really still basic statistics. All we must do is to compute the returns observed from one day to the next, and then we calculate their standard deviation, which we multiply with an annualization factor to obtain the usually quoted volatility per annum. As you can see, the realized volatility of our hedge portfolio was in fact 23%. Interesting. We sold 26% volatility and we realized 23% on our hedge. That is the volatility we were long. Okay, selling at 26 and buying back at 23, that sounds like earning money. It's as simple as that. Let's look at it another way. Let's assume we had sold those two options not with an implied vol of 26%, but with the actual realized volatility of 23%. Then would have realized 128 euro of premium income. 141 minus 128 equals 13. 13 times 100 is 1,300. And that is really close to the true profit we realized. This result is no coincidence. It is in fact so that on average, implied volatility trades more or less 3 points above the realized volatility. And this phenomenon cannot be explained by option buyers being ignorant or thoughtless, neither by option sellers being the smartest in capital markets. It's simply because by selling options, by providing optionality to capital markets, you actually position yourself as an insurance provider in the capital market. That means you are delivering a service to others, you are providing an utility, and clearly this service ought to be rewarded. I do in fact not know of any insurance market in this world where the premium you pay for the insurance coverage is less than what the insurance provider expects to pay out in terms of damage regulation. And that's also how the insurance business in capital markets works. Those who sell volatility are remunerated by an implied volatility which on average and over time trades slightly higher than the realized volatility. However, as in any insurance business, every now and then it becomes a very unpleasant and uncomfortable experience to be an insurance provider. The worst of all these phases was the Lehman crisis of 2008, at least in the history of the last 20 years. And that's why I will now take you to a closer look at this phase. September 2008. Lehman Brothers goes bankrupt and triggers a global crisis. For us, who act as insurance providers of capital market risk, the worst possible market environment. Let us therefore look at the evolution of the volatility risk premium during exactly this phase, from September to December 2008. The subprime crisis is still unfolding. Volatility is trading at 21.8% and we sell a straddle. Here we see how September 2008 evolved. There were two events of major significance. On September 15th, Lehman Brothers is allowed to go bust. The market that was already in a bearish mode crashes. And on September 19th, we observe a massive counter move, which was caused by a short-selling ban imposed for bank stocks in the US and Europe. A short-lived correction that was to be reversed before month-end. Of course, we will lose money in such a month. This was a major crisis event with an extremely high realized volatility. Here we see the P&L of our straddle position. We lost 4.1% on the straddle. And in our hedge portfolio, we also lost 0.3% to end up with a total loss of 4.4%. Let us look now at what happens in terms of realized volatility. What we experienced in September 2008 was a market with a realized volatility of 45%. However, we had sold 21.8. Obviously, we must lose money when we sell 21.8 and realize 45. If you think September was bad, wait until you see October. The month actually begins well, with the TARP fund being announced on the 3rd of October. Nevertheless, the market breaks down again as the Lehman crisis now develops into a global trust crisis, infecting more and more markets. In October, the realized volatility we observed in our hedge portfolio was 80%, but we had sold implied volatility at 41.8. Clearly, we again lost money in this month. 7.4% is the loss in the straddle, and in the hedge portfolio we actually made a small profit of 2.2, so that we net a total loss of 5.2%. What we just observed were two major damage regulation events, one following the other, which together produced a loss of roughly 10%. November 2008 was actually quite boring. The realized volatility was at 61%, and well, it's kind of hard to talk about boring market when you have a realized volatility at this level, except when you saw the implied volatility at 60.3 at the beginning of the month. These two values are very close to each other, which means that the volatility risk premium portfolio probably did not make any large profit or loss. In total, it was a profit of 0.7%. In December 2008, markets began to calm down. We sell volatility at 49% and realize a volatility of 45%, so that a net profit of 5.5% is earned. For the first time in a long time, the normal order is re-established with implied volatilities trading above realized volatilities. And this is exactly how the following months proceeded. If you look at this 4-month period as a whole, then that's how the volatility risk premium evolved, shown here next to the performance of the Eurostoxx 50. I personally would have preferred to be a volatility risk premium rather than an Eurostoxx 50 investor. And now, the same thing again in a long-term perspective. This is the evolution of the Eurostoxx 50 volatility risk premium. The short period you see highlighted in this circle happens to be the 4 months we just analyzed in depth. It's a pretty good performance. And if you think that you could only have done this in the Eurostoxx 50, you're mistaken. This is equally attractive on the S&P 500, the DAX, or on the Nikkei, or on any other equity index. What I'm showing here is a composite of volatility risk premiums on various different equity indices with a little bit more history. This is 17 years of volatility risk premium on equities, an impressively stable and steady positive performance. However, I'm quite puzzled about the fact that in our industry, the volatility risk premium in other asset classes is only rarely discussed. Let's change that. This is the volatility risk premium of bonds. It's exactly the same process, but with bond futures instead of equity indices as underlyings. Or the same with currencies. and probably most interestingly, is to compare the performance of volatility risk premiums with the performance of the traditional assets like those that you most certainly already own. The lines blending in show the performance of bonds and equities via two very common benchmarks. Frankly speaking, what this outperformance shows is that it is very much worthwhile to include volatility risk premiums strategically in your portfolio. And now, a small excursion, a difficult point. Most people have difficulty in accepting the persistent existence of the volatility risk premium. How can it be that over a prolonged period of time, people selling volatility actually manage to sell it above the realized volatility? Doesn't that require them to know how volatile the future will be? That's actually not the case. It suffices to continuously manage the process of selling and hedging volatility as demonstrated. And why that is the case, I will show you over here. The following analysis requires the development of two arguments. The first argument has a lot to do with the typical evolution of the realized volatility. Volatility is a stationary risk factor. It goes up, but will always come down and revert back to its mean. There is no crisis that will rage forever, and there is no stable period that lasts indefinitely. That's why the realized volatility curve looks a little bit like the sinus curve shown here. The second argument is about how options are priced in capital markets. All option traders, including myself, have no clue about what the future will bring. In particular, we do not know how volatile the future will be. That's why we base the pricing of options not on our expectations about future volatility, but rather on the level of the recently experienced volatility. We have a rear-view mirror that shows how volatile the recent past has been. New options are, on average, simply priced with a spread to this observed realized volatility. Let's draw this process in the graph. We pick a point on the realized volatility curve, from which on we draw a 1-month period, and then we add 3 Vega points. We now repeat this process on various different points of this realized volatility curve, and then we connect all these points so that we obtain an idealized corresponding implied volatility curve. Now we can highlight the profit and loss phases. The profit phases are those where the implied volatility is trading above realized volatility, and the loss phases are those where the opposite is happening. We begin with a loss phase, that is followed by a profit phase, then again a loss phase, and so on and so forth. My aim with this exercise was to illustrate very simplistically that if you continuously sell the same amount of volatility, you will, over the complete volatility cycle, harvest a positive volatility risk premium. Given that, the win phases are bigger than the loss phases. Hopefully, I've managed to convince you about the attractiveness of the volatility risk premium as an asset class. And although I am an enthusiastic volatility risk premium manager, I urge you for caution when investing in short volatility funds. This asset class bears enormous potential for moral hazard. Moral hazard means careless and reckless risk behavior. Before you entrust your wealth to a short vol fund or a volatility risk premium manager, there are a few peculiarities that require your attention. This is what I will discuss in our third and last film. Thank you for your attention. Although I'm founder and CEO of Crest, a volatility risk premium manager, I urge my clients to be very cautious when investing in short volatility funds. This has a lot to do with the moral hazard problem in the financial industry. I mean the problem that risk managers might be tempted to recklessly and irresponsibly manage the risks they handle on behalf of their clients. The problem is particularly virulent when outsiders, in our case the asset owners, cannot monitor the risks being built by their agents. And exactly that is the case when dealing with volatility risks. Firstly, it is difficult, if not impossible, for you or any external person to actually recognize the true risk profile of a short volatility fund by just looking into the fund. Secondly, volatility risk premiums have an asymmetric risk-return profile. That means they are characterized by long and lasting phases of positive performance that are followed by rare and short-lived but very large losses. Take both arguments together, and I believe it becomes intuitive why a risk manager might be tempted to take on too many of those asymmetric risks when managing his client's money. in the hope that the next large loss will only occur after his takeout of management and performance fees. I actually believe that the capital market crises that we observed over the past 20 years, like long-term capital, Lehman, AIG, and many others, were primarily due to the fact that the management team, or sometimes the whole system, was heavily misaligned. People were not personally exposed to the losses they produced through excessive engagements in short volatility positions. Now here I am, myself a short volatility manager, but only because I believe that we at RP Crest have found a way to deal with the moral hazard caused by asymmetric risk-return profiles so that we are truly aligned with your interests. In our company statutes, we have laid down that RP Crest will always pay low base salaries and is not allowed to pay any kind of variable compensation. The only way for us to make an extra earning is through a profit participation program, which primarily distributes shares of a fund called Partners Blend. This fund has a minimum holding period of 3 years and is obliged to invest all its assets with a minimum leverage of 2 into our own short volatility fund, which is, by choice, our only product. Through this construction, we, as risk managers of the fund, are overly proportionally exposed to the risks of our clients. Through the gearing, we risk losing all profits earned over the past 3 years. I believe this to be the best possible solution to solve the moral hazard problem. This construction does not guarantee that we will not incur large losses. It does, however, ensure that we will manage the funds entrusted to us in a responsible manner. Should you be interested to know more about us and our products, please come visit us on our homepage or get personally in touch with us. I thank you very much for your attention and interest, and I hope to see you soon again.